Okay, the name of this presentation is Investing in the Stock Market for Beginners. The most important thing I'll say in this presentation is at the very beginning here, which is buy low and sell high. So that's really the essence of the whole presentation right there. We're going to approach this presentation from what I'll call a funnel point of view. We're going to first talk about the big picture, which would be market conditions. Then we'll look at sector activity. Then we'll look at must-haves, variables, watch list, trading plan, and a couple other things. So right now, the current market conditions are that we're in a bull market, and we've been in a bull market for 10 years. That's the longest bull market in history. So that might say something about if now is a good time to get in the market or not. I'll be looking at the presentation from a couple points of view. When you look at stock markets, there's usually two things you look at, either fundamentals, which are like balance sheet, financial information of individual companies, or you look at technicals. And the technicals consist of charts, moving averages, lines of support, and resistance. I've done this for quite a while, and I kind of favor this technical point of view myself. Okay, market conditions for the last 10 years. This is a chart of the S&P 500, and the S&P 500 is the Standard & Poor's 500 largest stocks in the stock market. It's really the best indicator of what the overall market conditions are. And you can see right now that we started back in here. We began this bull market in March of 2009, and we've gone all the way up to the present right now. And hopefully you can see the following, that first of all, our 200-day moving average, which is sloping up, that's good. You can also see that the 50-day moving average of stocks of this S&P 500 is also moving up, and it's above that 200-day moving average, which is good. But there's a couple of things that are not so good, which, for example, is that a year ago we reached a high back in 2018, and we really haven't gone much further. We've kind of flattened this thing out a little bit, which is a little bit concerning. All right, the other thing I want to point out here is, for example, these lines right here, these little graphs on the bottom indicate volume, and if it's green, it's positive volume. If it's red, it's negative volume. And so we've mostly had positive green volume. The last little indicator I'm looking at here is what's called the relative strength index. Normally, the relative strength index is a good indicator as whether or not you should try to get in and buy something or you should try to sell something. This index usually, if it's 80, between 70 and 80, that means the market is overbought, which means it might be a good time to get out of some things or trim some things back. If it's down to 20, that usually means that the market is way oversold and it's a really good time to get in. Right now we're at 60, at least at the time I did this graph, which means we're probably it's still a good time to buy, at least according to this chart. Okay, so let's go on the next slide. Okay, this is a market conditions of the S&P 500 for just the last year. I'll point out some things about it. Okay, again, like I said, the S&P 500 is the best overall indicator of how the market's doing right now. I've pulled up a one-year chart. And by the way, I really favor using Yahoo. I like Yahoo Finance charts. They're easy to use. I've got indicators in here, for example, like that's the S&P 500 price action. That would be the moving average for 50 days, which would be this right here. And I've also got the 200-day moving average on here, which would be this line right here. All right. Another thing I want to point out is stocks don't go either up or down in a straight line. They go up a little bit, and then they might go up 2 steps and come back 1. They might go up 3 steps and come back 1. And for example, right here was almost a bear market right here. We went down 19.5% last December. We've gone up from there. We've gone down again, and now it's important to look at this point, which is that right now the little blue dot, this is the S&P price, the S&P 500. You can see right below the 50-day moving average. It would be healthy for this to move up above that. It hasn't yet, but it would be healthy for it to do that. And you can see that this chart was done on, let's see, it looks like, it doesn't give me a date here, but it was, I put this chart together on 148, I believe it was a couple days ago. All right, now, if you want to see, we're looking at sector activity now, and there are several sectors that you can look at, and what I'd like to look at now is over the last 10 years, what has been the best performing sector in the S&P 500. And in the last 10 years, I did a little chart from Fidelity. I've got a link to a website. You can look at this and you can do things like a 1-year performance, 3-year, 5-year, 10-year. Over the last 10 years, the Fidelity Select, these are all mutual funds. And this particular mutual fund is called the Fidelity Select IT Services Portfolio. And there's several stocks in this. If you clicked on that, you'd find maybe 10 or 15 stocks that make up this particular, maybe more than that make up this particular fund. And what you can see is that over the last 10 years, this particular fund has averaged over each year almost 21% per year a return, which is outstanding. So that's over the last 10 years. Now, just as a little kind of a thing to think about, something that you may not know about, but if you don't, here's something that's really important. It's called the Rule of 72. The Rule of 72 says, how long will it take me to double my money if I can earn a certain interest rate? And the way you find that out is you take 72 and divide it by the interest rate that you've been getting or you'd like to get. And I did this with a little calculator. For example, I took 72 and divided by 21, which was the percentage interest rate on that last slide. So this stock fund we looked at just a second ago doubled in price every about 3.42 years, or almost every 3.5 years it's doubling in price again, which is pretty darn good. Now let's look at the activity for the last year. In the last year, here is our list of, again, this list was, you see that little down arrow right there? That little down arrow indicates that I sorted this list on the Fidelity site and from top to bottom. And for the last year, it looks like, again, the Fidelity Select IT Services portfolio has done the best. It has reached, right now, currently, as of 7/31, it's had a 22.82% increase return, or that's really over the last year. So that's over the last year. This has still been the top fund. I also want to show you also that the second place was gold, the gold portfolio of funds, and the third place was the leisure portfolio of funds, which you can, these are leisure activity stocks. Okay, now year to date, as of August the 12th, when I put this presentation together, you can see that the gold funds have spurted out ahead a little bit here. They've gone from what we saw on that last slide to almost a 34% year-to-date stock market return, which is, again, fabulous. Because the average stock market return for most stocks and for overall has been around 10, 11%. So you can see that's pretty darn good. Okay, here's some under must-haves on our little continuing little funnel of how we're going to look at the stock market. Great stocks to invest in. These are like long-term kind of considerations. The first one is the Van Market Total Stock Market Fund. Total Stock Market Fund. There is its ticker symbol, VTI. The Vanguard Total International Stock Fund, which is VXUS. Amazon's been a really good stock, AMZN. Alphabet, which is really Google. You know, there's Google. That's the stock symbol for Google. Facebook, FB, and Intuitive Surgical, which is ISRG. Those are good things to think about for the long term, like over 5 years, 10 years, whatever. Okay, something else under must-haves and where to start. 3 steps that every beginning stock market person who's studying the market ought to do or consider doing. For anyone just starting to invest in the stock market, I'd recommend you learn about the investor psychology and the traps we all fall into. I'll show you that on the next slide. Second, I'd recommend you start following the market regularly, and you can do this either on your TV, computer, or your smartphone with apps. That would be CNBC, Bloomberg TV, Wealth Track, which is a 30-minute show that comes on Sundays, but you can tape that. Consider Wall Street Journal, and also, like I said, Yahoo Finance. Those are my top picks that I look at to keep up with the market. And then last but not least, get some skin in the game. Spend $1,000 on either a stock or a mutual fund or an ETF. An ETF is a exchange traded fund. It acts like a mutual fund, but the fees to get into it and out of it are a lot less expensive. So to do that and get into any kind of stock, you're going to need to have a brokerage account. And here are 3 of the best brokerage fund companies to think about: Ally Invest, Charles Schwab, and Fidelity. Those 2 in the bottom is what I have had I've had accounts with before. Okay, under that last slide, we talked about the emotions and how the psychology of the market works. Emotions are the worst enemy of the stock market. Your emotions are. Here's something you don't want to do. You don't want to buy at the top and sell at the bottom and then keep repeating the process till you're broke. You don't want to do that. Here's a little pictorial of the cycle of emotions that go through when you're going through a stock market. A couple cycles here. Start off with optimism, get a little more excited, get thrilled to death, get euphoric, and that's when everybody piles in. And when everybody piles in, that's when usually the market's topped. And then as it starts to go down, people get a little anxious. They start saying, well, it'll come back. Then they start to get afraid. Then they get desperate, and then they panic. And a lot of the people who don't do this right sell out right here at the bottom, and then we start a new cycle. So that's kind of the way that the emotions work. Don't let your emotions get, when you think when you feel like emotionally it's time to sell, it's probably time to buy, and vice versa. Here's something you can look at for how you can gauge as to how the market's doing currently. It's a psychological kind of a little index. You can go to CNN, there's or CNN Money, and there's the website, and you can tell what the current fear and greed index is. For example, the market runs on fear and greed. And right now, as of when I did this, the market right now is in fear, which is 27. 0 is extreme fear. The lowest I've ever seen it is 3. And when it was at 3, that's time to buy. When it's extreme greed, like around 70, 90 or 100 or so, that's the time to get out. So that's what it was yesterday, 27. Previous day, it was 23. A week ago, it was 27. A month ago, we were in the greed category, which is 64. And a year before that, it was at 56. Okay. Warren Buffett, who's one of the most famous investors out there for 40 years, he has this famous saying: be fearful when others are greedy, and greedy when others are fearful. So what he's talking about there is don't let your emotions get control of how you get into and get out of the stock market. Okay, here's some technical things that I usually use as my indicators as to when it's a good time to be in the market and so on and so forth. This is under the variables portion of this little funnel we're looking at. Let's see here. This is the 200-day moving average. You can see it's going down here and then starting to come back up and starting to slope upward. This is the 50-day moving average, and this is what a lot of traders who are actually in the market quite a bit look at this as a reliable way to look at how the market's doing. You see it's going down here, and then it starts going back up, and then it crosses over. It's crossing over the 200-day moving average, which is what's called a golden cross. This golden cross is usually an indicator of when it's time to get in the market, and that's something that we'll look at a little bit later on, just a few minutes here. All right, some other technical indicators that are under this variable situation is, one thing is, this is let's see, it looks like this is the S&P 500 from back in 2011 all the way up to pretty much to what it is right now. And you can see that we have been going up, and if you drew a line where those little bottom pieces are where they meet, you can see that so far back in, let's see, 2012 and then in 2014, we touched the line, and this is just a line that a trader drew, or a technical analysis person drew this line. And you can see that we haven't crossed this line until right now. Now, it looks like we've crossed, well, back in 2015. We went below this little line, which is an indicator that there's a problem here. And so the way you look at this whole little picture is, the trend is your friend until it isn't. And it looks like it isn't right in here. Okay, here is a situation, what's called a death cross. This is the 50-day moving average. This was the 200-day moving average, and you can see when the 50-day crosses back down below, if it crosses below the 200-day moving average, that's called the death cross, and that is something that indicates that it's time to really jump the ship and get out, because things are going to go down quite a bit faster from here. Okay, this is a chart indicating buy signals and sell signals based on this 50-day, 200-day crossover strategy. You can see that we want to buy here, although that's a mixed signal right there, which means that, and you don't want to get caught up in these little mixed signals. You want to kind of wait until you see a clear emerging trend, because here it went down. That is, the 50-day moving average crossed under the 200-day, but just slightly. The rule of thumb on this is usually wait 3 to 5 days, maybe even 10 days, to see if it's going to stay, the 50-day moving average is going to stay under the 200-day. If it does, that probably indicates that it's time to get out. But you can see here where it crossed under, it never did go back above the 200-day moving average until we got down to here. So all this is very painful situation for a person to be in if you're in the market at that time. Okay, looking at the market again for 10 years. This is the S&P 500 again from 2009 all up to the current day, which was like yesterday or so. And you can see that we're at 29. The market's sitting at, this S&P that is sitting at 29.27, which again is above the 50-day on this chart. And we've got a relative strength index of 60, which is positive. Anything over 50 is positive, but over 80 is going to be a oversold condition. All right, let's see here. I think my pointer's stuck. Okay, now back to this. Okay, this is a 1-year chart, and this is a little bit disturbing here. It looks like this is a little bit troubling here. This was 2 days ago. The S&P 500 29.27.54 is not above this 50-day chart, which means it needs to be above that in order for me to feel a little more comfortable about the market. You can see that the RSI index has gone below 50, which again is a little bit something a little concerned about. It's not the end of the world, but it's something to be concerned about. Okay, again, here's a watch list of some stocks to consider. These are been very high performing stocks: Amazon, Google, Intuitive Surgical, Facebook, and Axon Enterprises. These are all considered pretty good stocks for the long term to hold. Here's something to consider also. This is what's called a sector fund trading strategy. It's something that I've had a lot of good success with this over the last couple of years. And what I would do is I would pull up every month, I'd pull up the monthly, what's leading in terms of these sectors from Fidelity. For example, at the time I did this, and by the way, here's the website, link to the website. Pull this up. So what's the leading number one best for the month, actually for the month year to date, for this Fidelity Select portfolio of stocks? It would be it looks like the Select Semiconductors. So the strategy is this. You find the leading fund, or it could be an ETF that mirrors the fund, and ETFs are, like I said, less expensive, and they get into and get out of, and there's not a 30-day holding period. But anyway, find that leading sector, in this case semiconductors. Get into it, stay into it, and as long as it stays in first place, as long as it, like each month check it, as long as it stays in first place, stay in it. If it starts to slip below first place and something else takes its place, like goes up higher, like maybe gold or maybe one of these other ones goes into it, then sell out of the semiconductors and go into the different fund, and do it as long as it's performing at a new high. That's really kind of the indicator here. And I've done that, like I said, over the last couple of years, and that seems to work pretty well. Now, if neither the one you were in before or the one you're about to get into has reached a new high, I would say go into cash. Let me repeat that. If the fund that you were in last month and the fund you're about to go into, neither one of them has reached a new high, it's probably a good time to go into cash, because it might be getting ready to see something significantly different going on in the market. Okay, so here's the question. Should I get into the market right now? And I'm talking right now. And here's some things I would look at if I were asking this question of myself. First of all, I would look at the big picture. And the big picture is the S&P 500. One thing to look at in this picture is that the 200-day moving average, when you do a one-year chart using Google Finance, click on chart, 1 year, and also add indicators, like these are indicators, 50-day moving average, 200-day moving average. You can click and add those. First of all, the thing I'm looking at is the 200-day moving average. Is it going up? Is it going down? Or is it flat? In this case, it's flat. If it's flat, that probably means that the market overall is trying to decide. It's kind of in a state of indecision, and it means that it's not a bad time to be in, but things could go down from here. But anyway, second thing to look at, the 50-day moving average is above the 200-day, which is good, but the S&P 500 itself is below the 50. If it's below the 50, that's a little bit concerning to me. You can see also that the relative strength index is below 50, which is not good. And if I were looking at this right now, I would say I probably don't want to be in the market until something resolves itself. And when I say that, what I'm talking about is either we go down to where the RSI is 20 or below, or the S&P 500 goes in the opposite direction and goes up and creates a new high. Until it gets to a new high, or in this case bottoms out, maybe goes down in here and somewhere, which would be around 2,400, I'd probably not want to put all my eggs in this situation. I probably wouldn't want to be in very much exposure. Now let's look at an individual stock. Probably if I was going to look at one stock to judge the market, not the S&P 500, but just one stock, I'd probably look at Apple. And so for Apple, we do a chart, we do a 1-year chart, and we put the 50 and the 200-day moving average on here. And here's some things we see. For example, right now, looks like Apple's 200-day moving average is going in the down direction. That's not good. That's not good at all, because usually the way the Apple goes is the way the market goes. That's not good at all. You can see that the 50-day is still above the 200-day moving average, and the stock price itself is above the 50-day, which is good. But this is pretty troubling right here, the fact that the trend is down. So that's kind of a, like I said, kind of a bad indicator. Let's look at another situation. Here's Amazon. Amazon, some things to think about Amazon. Back in 2018, Amazon set a new high of $2,000 per price per share. It's never gotten close, but it's never gone to a new high over the last year. That's not a good sign. Also, Amazon is trading below its 50-day, but it's still above its 200-day moving average, but it's below its 50-day moving average. And in this situation, I wouldn't consider buying Amazon until the RSI got below 20, or like around 20, or until something happened. Like if it goes below the 200-day moving average, I would not get in it at all until some past bottom has been reached. And it looks to me like one past bottom would be right here or right over here. More like over here, because let's face it, we're in the 10 years. We've had a 10-year uptrend in this market, so we may be near the end. And then here's something else to think about. When stocks go up, usually there's other things that go down, and vice versa. So here's something to think about. This is a current chart of a stock or a fund called GDX. GDX is gold miner stock, and gold, the way this stock goes is the same way gold goes. For example, if gold goes up, this stock goes up also. It moves in the opposite direction of the S&P 500, and if we do a one-year chart on it, you're looking at the 50-day and the 200-day moving average, we can see a couple things have happened. This is a one-year chart, and you can see that the 200-day moving average was going down, and then here around June, it starts going back up. And if it's sloping up, and you can also see right here that we've had a recent golden cross, which is the 50-day moving average has moved above that 200-day moving average, and it's above it now. And you can also see that the gold GDX stocks have been going in not a straight line, but they've been going up. You can also see that the RSI index is above 50, but it's not yet to 80, and 80 would be oversold in this situation. So that is an indicator to me that the stock market in general is fearful, because usually people get into gold when things are fearful, and it wouldn't be necessarily a bad time to put a little money into the gold mining stocks or gold stocks in general. Now, last but not least, like I said from the very beginning of this little presentation, the whole point of this is to buy low and sell high. And I'm hoping that with this little presentation, you've got a little more information about what really buying low means. What does low really mean? And what does high really mean? And I think technical analysis is a good way to kind of get a focus on what these things, what the low point and high points mean. So I hope this has been helpful to you, and maybe looking over this and getting some more information on your own and putting all these things together might be a way to start learning more about the market. And lastly here, I'd like to thank my helper for put these together with my assistant. His name is Boris to Death.